Hi, guys. We're just taking a quick look at Alphabet Incorporated here on the Guru Focus website. And if you're interested in looking at these numbers for yourself and to the fundamentals, please take a look at the link in the description below and you can have a look for yourself. So, Alphabet, obviously the parent company of Google. This is the main page on Guru Focus. And the first thing I like to take a look at, as usual, is the warning signs or the good signs that Guru Focus has picked out for us. And you can see there are a few warning signs in the red and orange and two good signs. So let's just take a peek. So for the severe warning sign, it's telling us that operating margins have declined. And it's actually saying operating margin has been in a 5-year decline at an average rate of minus 3.0 or 3.8%. So let's just find out what it actually looks like. We'll click on that. Operating margin, you can see the graph slightly declining there. And from about 30 to 35, declining to mid to low 20s here as of December 2017. So, okay, there is more to this. So we'll have to do some research before we decide that this is actually a problem. But usually declining operating margins, especially over 5 years or more, could be a pretty strong indicator that something is changing within the marketplace for that company. And it's something that you really need to know about before you invest. So it gives us a brief definition down here. Operating margin, also known as operating income margin, operating profit margin, and return on sales, is the ratio of operating income divided by net sales or revenue and as a percent. So it gives you the calculation. It's operating income divided by revenue. So what is operating income? Well, it's revenue minus cost of goods sold minus selling and general and admin expenses, SG&A, minus research and development, minus depreciation, depletion, and amortization, all divided by revenue. So that is something that I really want to find out what's going on. And I imagine this is just a guess off the top of my head, but something to do with increased competition with websites like Facebook, especially, who are increasing their efforts in advertising and competing for advertisers' dollars, where Google, still the dominant player in that space, but was once obviously probably closer to a monopoly on online advertising. So here you can see operating margin. You can get right into the calculations. Take a look at the chart here over the past 10 to 15 years. So scroll down a little bit. It does compare it to Facebook, whose operating margin is quite a bit higher, apparently at 49%, almost 50%. So very strong margins over at Facebook. And here you can get into the calculations a little bit and just see what's going on. So obviously you'd have to go into the filings and see exactly what the management's description of this is and perhaps why they believe that that is tightening. But there are a lot of factors at play there, so worth a little bit more research. I would say that is justified here as the severe warning sign that Guru Focus has picked out for us. Something to be well aware of if you're investing in Google. So let's take a look at the 3 medium warning signs. So one that comes up quite often these days, beginning of 2018, in a highly valued market, is that the price is at a close to 10-year high. So Google has been growing very strongly for a number of years now, and so has the stock price, which you can see up here at the top on a 5-year graph, 10-year graph as well. So if you had bought this, it only goes to 2014. So if you had bought this 4 years ago, you would obviously be doing very well. And that's all it is. It's just pointing out that it's at a 10-year high. And if you're hoping to buy this business at a discount, then you really need to decide that it's discounted versus its earnings or its future growth prospects. And so obviously that's going to be different for everybody. So 10-year high, close to a 10-year high for the price to earnings ratio. So that kind of goes hand in hand with the price. And obviously price moving along quite a bit faster than earnings. And actually you can see that right here. It's almost at a 60 price to earnings ratio for the trailing 12 months. And that is quite a high number. So unless you think Google still has a lot of room to grow in different areas, which you very well may be correct, then that would be a very, very high valuation compared to a lot of other companies. So, but maybe justified. I'm not saying it isn't, but that is a decision for you to make. So, high price to earnings ratio and price to sales ratio, it's also telling us that it's at a close to a 5-year high. And current PS ratio of 6.9. 7.65. So the ratio, or the average, I guess, would have been a 6.9. Let's just click on that and find out. But you can kind of see it fluctuates here a little bit between 8, 6, 5. So kind of flattened out in the high 6s. And so I wouldn't say I see a trend in this at all, but obviously that's a fairly high number again. So this would not be most people's definition of a discounted company. But if you believe that this company has a lot of room to grow, then obviously it still may be at a discount to what its future prospects are. But that is up to you to decide. So those are the medium warning signs. We see 2 good signs here that Guru Focus has picked out for us. And so a very strong interest coverage, comfortable. So it gives us a little bit of context. Ben Graham prefers companies' interest coverage is at least 5. And that tells us that it has enough cash to cover all of its debt and its financial situation is stable. So I think like a lot of tech companies that you see these days, they hold a lot of cash, and debt is just a tool that they use for various reasons, including saving on taxes. So I would not be too worried that Google is a company that's saddled with debt, but it is good to know. So that is pretty much it. But I would look into the filings a little bit more to find out what its financial situation is. And the other warning or good sign that it tells us is that revenues show consistent growth. So I think that is fairly evident. You can tell that Google has grown fairly strongly over the years, and it's mainly ad revenue, but also all kinds of other revenue and other things that it's involved with. So it's almost $160 per share right now of revenue. And so that's quite a strong trend. We can click on this button here and see a little bit more. You can even get it on a quarterly basis. I like to look at that sometimes if there are seasonal variations in a business, but and that may be the case with Google with end of year marketing. It all depends on marketers' budgets, but you can see a very consistent growth in revenues in this case. So, it tells us the growth rate has averaged about 45% a year. So obviously that's an incredibly high growth rate. But if you see signs of that declining, which would only be natural, then that could be something that is a concern. But here actually it tells you the rate here quarterly. So yeah, that's something to research a little bit more and find out whether or not you think this company is slowing down. And with its size, that would not be too out of the ordinary. So anyway, that's pretty much it for Alphabet. Obviously, you can see there's a lot more information to get into and to research on the Guru Focus page. But that's just a quick overview of some of the warning signs and good signs for Alphabet. And if you want to take a look yourself, as I mentioned, there is a link in the description. Please take a look if you're interested. And that's about it for now. Okay, thanks, guys. Bye for now.